Welcome everyone to this webinar on the 2021 African Economic Outlook for Asian audiences. The theme for the African Economic Outlook for 2021 is From Debt Resolutions to Growth, the road ahead for Africa. And the report is divided into three different chapters. In chapter 1, we look at Africa's growth performance and outlook amid the COVID-19 pandemic. Now, Africa has been relatively less impacted by the COVID-19. The recession experienced in Africa was lower than elsewhere in the world. If you look at the left panel, you see that the drop in GDP for Africa was less than the drop in Latin America, in North America, in Europe, and even in Asia. So Africa experienced a relatively lower impact from the COVID-19 recession. GDP dropped by minus 2.1% in 2020. However, we project that GDP is going to rebound by 3.4% in 2021. This rebound is, however, going to be conditioned on access and universal access to COVID-19 therapeutics and vaccines, the rebound of tourism, the return of financial inflows, and several other factors which we'll discuss later. Now, on the right panel, you see, very interestingly, that there's been a close co-movement between Africa and Asia's recovery. Asia seems to be leading Africa's recovery, and there seems to be a one-for-one correlation between the two recoveries. And this tells us that the connection between Africa and Asia, in terms of the impact of the recession and the recovery, is strong. And so stronger collaboration will help to make the recovery more durable. If you look in this chart, you find that the recession that Europe and other economies experience is quite different from the way it has affected Asia and African economies. In the next slide, we see that the impact of the pandemic varies across countries and regions. Tourism-dependent economies experience the sharpest growth decline. GDP dropped by an average of 11.5% in tourism-dependent economies. For example, in Seychelles, GDP dropped by 12.5%, in Mauritius by 15%, and so on. However, non-resource intensive economies were the most resilient. They managed to stay afloat with GDP at 0.9% in 2020. All these groups of economies are projected to recover in 2021 from the recession that was caused by the COVID-19 pandemic in 2020. If we look regionally, we see that Southern Africa was the most impacted by the recession, dragged especially by South Africa, which suffered a GDP loss of 8.2% in 2020. Overall, in Southern Africa, GDP dropped by 7%. And East Africa was the most resilient, with countries like Ethiopia, Uganda, and Tanzania staying afloat, maintaining positive GDP growth in 2020 in spite of the COVID-19 shock, thanks to relative better diversification of these economies and less dependence on commodity prices. Macroeconomic fundamentals have weakened as a result of the pandemic. We have seen that counterbalancing forces kept inflation subdued. However, core inflation has risen in most of the economies. So the increase in the cost of logistics and distribution put an upward pressure on inflation in many countries. But then, lower commodity prices, especially for oil and energy-dependent economies, kept inflation muted at 10.4% in 2020. We expect that inflation will moderate in Africa to 9.4% in 2021. Exchange rate depreciations have also continued since the start of the pandemic. And this is especially so for frontier market economies such as South Africa, Angola, Nigeria, and the rest of them. And the main driver of these exchange rate fluctuations have been the capital flight to safety by investors who have withdrawn their investments in search of better returns in safer havens such as Japan and Germany. Fiscal deficits have doubled and financial inflows shrank. Fiscal deficits doubled from 4.6% in 2019 and climbed up to 8.4% in 2020 as a result of the additional spending that many governments had to do to cushion the effect of the COVID-19 pandemic. This year, we expect that there's going to be some fiscal consolidation in many countries, especially as the recovery kicks in and revenues increase, and revenues even from sale of commodity prices also increase for many countries. Financial inflows have been disrupted. Foreign direct investment dropped by 18% in 2020, from around 45 billion to about 37 billion. Overseas ODA, overseas development assistance, also dropped by 10%. Portfolio investment actually reversed from net inflows to net outflows in 2020. And remittances, which has become the most significant source of financial inflows, also dropped from around 85 billion in 2019 to somewhere around 75 billion in 2020. And if these financial inflows do not rebound in 2021, then the projected recovery might not materialize. COVID-19 impact has reversed hard-won gains in poverty reduction in Africa. As a result of COVID-19, the poverty incidence in Africa increased by around 2.3 percentage points in 2020, which translates to around 30 million people slipping into extreme poverty, living on less than $1.9 a day in 2020. In 2021, if the right policies are not put in place, we project that another 39 million Africans could slip into extreme poverty without the right safety net policies from government. Now, with the benefit of hindsight, we can look back and see how lockdowns have helped Africa to contain the spread of the virus. We did some analytical regressions, and we found that COVID-19 restrictions started to have an impact on reducing the number of infections in the continent about 30 days after they were instituted. And when we compared the effectiveness of lockdowns in Africa to other regions, especially in the OECD, we find that the effectiveness of lockdowns in Africa has been relatively minuscule. It's been marginal compared to how effective it has been in other parts of the world. Particularly, we also find that there's a strong negative correlation between countries that use more stringent lockdown measures and the impact on GDP. So countries that had more stringent lockdown measures also suffered higher GDP loss and industrial production loss in 2020. And the policy priorities from this macroeconomic environment from Africa, policy priorities for policymakers to support and build the recovery include to continue to support the health sector to consolidate the gains that have been made against the pandemic. Policymakers also need to sustain the monetary and fiscal support to underpin recovery. Fiscal and monetary stimulus packages should not be prematurely withdrawn until the recovery becomes more durable. Policymakers need to expand social safety nets to make growth more equitable and to cater for the poor, especially the vulnerable groups, women, youth, those who are working in the informal sector, and those with lower levels of education. Policymakers need to scale up active labor market policies to retool the labor force for the future of work. There needs to be massive retraining of workers to make them fit for purpose for the digital economy of today and of the future. Policymakers need to accelerate structural transformation through digitization, industrialization, and diversification. And more importantly, governments and policymakers need to strengthen regional and multilateral solidarity to enable shared and sustainable recovery. In chapter 2, we look at debt dynamics and consequences. This is the meat of the report. So COVID-19 interventions caused a surge in gross financing needs and debt in Africa. Gross financing needs have surged since the onset of the pandemic. Many governments had to spend more to cushion the effects of the pandemic. And most of the spending had above the line budgetary implications. A few governments have also used revenue reduction approaches to help support families, to help support firms and governments to cushion the impacts of the pandemic. Overall, on average, the gross financing need for African countries has been 12% of GDP. Usually, the threshold we want the gross financing need to stay below is 15%. But we see that many countries from the chart to the left of the panel have exceeded this 15% level of gross financing need. Some countries like South Africa, Tunisia have gross financing need above 40%, which means that they need more financing to support the recovery process. As a result, public debt levels have risen significantly in many African countries. And this is particularly so for other resource-intensive economies. Now, we did a debt decomposition in the report, and what we find is that there are three main drivers of the debt accumulation in Africa. One of the main drivers of debt accumulation in Africa is exchange rate depreciations. Just the fact that African currencies are depreciating means that automatically, because most of the debt is valued in foreign currency, the value of the debt just increases automatically, just because the value of the domestic currency has depreciated. We also find that another main driver of the debt accumulation in Africa is the interest expenditure, the amount of interest that governments pay to service their debt. And this is because of the higher coupon rates and the higher interest rates that governments have had to pay to contract new debt. We also find that primary deficits have accounted for a major chunk of the debt accumulation. Many governments have run budget overruns. They've carried out big push public investment projects. Other factors include poor governance frameworks, low transparency, the increased military expenditure to contain insurgency in the region. All of these factors have put together have caused a surge in Africa's debt levels. As a result, debt to GDP ratio is projected to climb by 10 to 15 percentage points because of the additional spending on COVID-related support, the reduced revenue, and other factors, structural factors that were already in the background before COVID came. So debt to GDP ratio is projected to increase by 10 to 15 percentage points. So by the end of 2015, Africa's debt to GDP overall might be somewhere around 70 to 75% of GDP. The composition of Africa's debt continues to shift to non-traditional sources. For one, multilateral lenders such as the World Bank, the African Development Bank, and the International Monetary Fund, they have maintained their share in the size of Africa's external debt. 20 years ago, multilateral lenders used to account for around 30% of Africa's total debt. By the end of 2019, they still account for about 30% of total Africa's debt. But bilateral lenders, Paris Club lenders, which used to account for most of Africa's external debt, have significantly reduced. In the year 2000, bilateral lenders and Paris Club lenders used to account for 2% of Africa's total debt. By the end of 2019, they only accounted for 27% of Africa's total debt. The more interesting part is private bondholders and commercial banks, which has more than doubled in the last 20 years. In 2000, it used to be only 17%. By the end of 2019, it was about 40%. So the debt landscape for Africa has changed, and this change comes with a lot of implications. Interestingly, also, if you look at the individual entities of Africa's debt, you find that China has become the single most significant creditor to Africa. China alone accounts for about 13% of total Africa's external debt, followed by bondholders. Bondholders, private investors, account for around 27%. And then you have the World Bank and the IDA. You have bondholders and several other countries in Asia, including Japan. Japan accounts for around 2% of Africa's total debt. You have India. You have Korea also. And the implication is that any discussion on debt restructuring or debt resolution, countries in Asia have a big and significant role to play. And we'll come back to this by the end of the presentation. Now, this changing landscape of Africa's debt also brings along with it significant vulnerabilities. For one, many countries are now in debt distress because of different structures and terms of contract of the loans that they have. About 10 years ago, around 17 countries were rated as being at moderate rates of debt distress. But by the end of 2020, only 2 countries were in Africa with debt sustainability assessments. Only 2 countries were rated as being at low risk of debt distress. 6 countries were already in debt distress, and 14 others were at high risk of debt distress. So, and with the COVID-19 impacts, we see even more countries might get into a high rate of debt distress or even in debt distress in the horizon as a result of the additional spending in the midst of reduced revenue. We also see that the interest expense as a percent of revenue has been on a steady increase for Africa. At the end of 2019, African countries spent around 18% of all their revenues on servicing debt. And this is above the comfortable thresholds that that economists will usually recommend. So in chapter 3, we look at debt resolutions and the nexus between governance and growth. If you look almost for the past century, since 1950 until 2007, we take a look at all the restructurings that African governments have gone through. And we see that African countries have restructured privately held external liabilities 60 times and have restructured Paris Club debt 149 times between 1950 and 2017. And these restructuring processes have been more protracted and in many cases disorderly because of the more complicated debt structure that many African countries have used, going beyond the plain vanilla structures that used to be common in the 1980s. For one, a lot of Africa's debt has now been collateralized, and collateralized on natural resource capital, on oil rents, on oil revenue, on minerals, and all sorts of collateral. There's also been a lot of litigation related to Africa's debt, and recently vulture funds, the kind of experience we saw in Chad and in Mozambique, would drag the process of restructuring. And we've also had many countries using domestic areas, which is a type of forced borrowing, to contract debt. The thing about domestic areas is that it doesn't appear on the headline numbers for debt. But on average, African countries owe domestic areas of around 3% of GDP. And this is significant. For some countries, domestic areas are around 40% of GDP. 40% of GDP or 40% of their public debt. Domestic areas accounting for 40% of available public debt. And there's also been, and this complicated structure of debt has made it more difficult to restructure debt and to resolve debt issues. So to achieve speedier and less traumatic debt resolutions, there's need for enhanced coordination and reforms in the global architecture for debt resolution. And that's what we advocate in this report. There needs to be a strengthening of the nexus between good governance and growth. Now, debt restructuring has often not been associated with improvements in governance and growth. In the year of the default, you see here we show that the level of growth is low, and the level of governance. And then if you go back to those same countries 5 years after default, we notice that governance performance worsened for most of those countries who had debt restructuring, and the growth performance too was not good enough. So most countries that have gone through restructuring, if you go back to those countries 5 years after restructuring, we notice that governance became worse and growth also became worse. So restructurings have not achieved the kind of growth friendly growth stimulation effect that they're expected to have accomplished. And the evidence also shows that Africa has a public investment efficiency gap of 39%, partly due to poor governance. So it means that for every $1 spent on public investment project, around 40 cents or 39 cents is lost due to poor governance, corruption, and leakages. So African countries must eradicate all forms of leakages in public resource management to strengthen the links between growth and governance. Now, to sum up, the main policy implication from the report is that we need to fix the global architecture for debt treatment to promote orderly restructuring and resolution for African countries through reinforced comparability of treatment clauses that bind together private and public creditors. So creditor coordination is the big issue for debt restructuring, and the global community needs to come together, bring all creditors to one table, and improve this coordination among creditors and debtors, so that debt restructuring and debt resolutions can be less costly and less difficult. African governments also need to leverage legal innovations. So new debt contracts need to incorporate collective action clauses, aggregation clauses, and pari passu clauses, legal innovations that make it easier to coordinate among creditors, so that if a majority of the group of creditors agree to a restructuring, it makes it binding to all the creditors in any bond series to participate in that restructuring process. African governments also need to facilitate orderly resolutions through financial innovation. The use of value recovery instruments is strongly advocated and recommended. So governments need to use state contingent and even policy debt contingent debt instruments that link debt repayments to maybe GDP or commodity prices, to encourage more participation by creditors. So that if a country is facing a difficulty today, you can grant that country debt relief, uh, being encouraged that in the future, when the country starts to prosper, you can recoup some of the credit that you lent to that country. This will help creditors to further participate in debt restructuring processes. So sticks and carrots should be integrated in Africa's debt contracts. But decisively, African governments need to take bold governance decisions by strengthening and modernizing domestic resource mobilization, by curbing leakages and illicit financial flows, improving transparency and debt management capacity, and implementing structural reforms that drive digitization, that ensures that there's fair competition in the market. So there's free entry, free exit. There's no monopoly power that pushes us out new entrants and entrepreneurs in the business. So the 5 key takeaways we would like you to take from this presentation. The first is we want you to recall that Africa is projected to recover this year from its worst economic recession in almost half a century. And the good thing is that for the medium term, the bank projects that GDP is going to grow at above 4% in the short to medium term. So for the next 3 years, this recovery is projected to be durable and high. So there's a lot of opportunities. There's a lot of prospects for sustained growth. Now, although access to COVID-19 therapeutics and vaccines have been slow, many economies have reopened to business, observing relevant health protocols. So many countries, although there's been limited access to vaccines and therapeutics, many countries have opened. So Africa is open to business with the relevant health protocols in place in most countries. There's need for stronger collaboration and business ties with Asia to make sure that this recovery process between Asia and Africa is durable. We saw in the first chart that we showed that there's a strong link between the recovery process in Asia and the recovery in Africa. And this is particularly so because of the strong trade links between Asia and Africa, accounting for close to 40%. 40% of all of Africa's trade is with Asia, with China, with Japan, with Korea, with India. And so the recoveries are intimately tied together. So closer collaboration in business will help to strengthen this recovery, to accelerate the speed and make sure that it's more durable. Now, the fourth point we would like to take away is that the success of every debt relief and restructuring effort that Africa would be asking for would depend to a great extent on effective participation by Asian countries and our Asian partners. The fact that China alone accounts for most of Africa's credit, in Japan and India and Korea, means that there cannot be any meaningful conversation about debt relief, debt restructuring, or debt workouts without our Asian partners, sitting to the table and agreeing on a meaningful debt restructuring program. And finally, improved pharmaceutical technology information sharing between Asia and Africa could help to speed up production and supply of health resources in Africa. So collaboration, the success story that Korea and Japan and China and the other countries have experienced in managing COVID and producing some of the masks and the accessories to manage the environment, to manage the crisis, has been commended. And stronger collaboration with Africa would help to share some of this knowledge and ensure that no continent is left behind in responding to the virus. I'd like to thank you for your attention, and we look forward to your questions and a very robust conversation on this. Thank you.